The Roth has such awesome tax advantages, tax-free growth, tax-free income. However, if you don't follow the rules and requirements, you might end up owing tax or a 10% penalty on your Roth. So today we're going to talk about how to help avoid the taxes and penalties on your Roth IRA. Those just joining our channel, my name is Scott Sierens. I run a retirement planning and investment management firm where we help families and individuals, people just like you, understand when they can retire, how much they can spend in retirement, and how to minimize the taxes on their IRAs, 401ks, and investment accounts. If you need help in those areas, go to lifemoneyshow.com, click on the Work With Us tab. Now with the Roth, you get tax-free growth and tax-free income as long as you follow the rules. But if you don't, you may end up paying income tax, a 10% penalty, or both. And we don't want you to pay those penalties or the income tax. We want you to get that money tax-free. So today we're going to talk about the 3 requirements that you must satisfy to be able to get that tax-free income from your Roth IRA. Now, you really need to satisfy a combination of these 3 requirements. You need to satisfy number 1 and number 2, number 1 and number 3, or maybe in your situation, you have to satisfy 1 and 2 and 1 and 3. And we'll talk about it all as we go through. Now, the Roth can be really confusing sometimes, you see, because there's 2 parts when it comes to your Roth contributions. You've got your Roth contributions, and then separately, you have your earnings. That's the tax-free growth and the tax-free income that I've talked about. I mean, that's the real advantage of the Roth is the earnings, the growth, the income, because your contributions, you already paid tax on those. So one thing that I just wanted to kind of say is your contributions at any point in time, any age, you can take your contributions out tax-free because you already paid tax on them when putting them in. You can take those out tax-free. Today, we really want to focus on those earnings, that tax-free growth and those tax-free withdrawals that you're going to want to take out in your future. So with that, let's talk about the first requirement that you need to satisfy to make sure that those earnings are coming out to you tax-free. So the first requirement that you have to satisfy is that you need to be age 59 and a half or older to get the tax-free income from your Roth IRA or Roth 401k. So if you're planning to retire early, really pay attention to this rule. You see, if you were to take the earnings out prior to age 59 and a half, you're going to be subject to a 10% penalty plus income tax on those earnings that you're taking out. So this is not something that you really want to utilize prior to age 59 and a half. Now, there are some exceptions to the rule. For instance, if you're utilizing the funds to buy your first home or for birth and adoption expenses or for college expenses or if you're permanently disabled. Now, if you're looking to use any of those exceptions, I would say talk to a qualified professional prior to utilizing those exceptions, making sure that you match what the exceptions are. However, if you're not using one of those exceptions, taking the distributions from your Roth prior to age 59 and a half, you could be incurring penalty and income tax. Now, let's say you satisfy this requirement. Like I said, it's a combination. You also have to still satisfy requirement 2 or requirement 3 or both, depending on how the money got into your Roth. Did it get into your Roth through Roth contribution or did it get into your Roth through Roth conversion? And they have 2 similar but different rules. And so that's what we're going to talk about next. I'm going to talk about the Roth contributions, and I'm going to get rid of some of the confusion that I hear about in the Roth contributions, as well as you have to understand the difference between your Roth 401k and your Roth IRA. And then the third requirement we're going to talk about is all around Roth conversions. So if you're doing those to help reduce your long-term tax burden, stick around for that one as well. So requirement number 2 that you might need to satisfy is distributions must meet the Roth contribution 5-year rule. So what does that mean? Well, what it means is that 5 tax years must pass by from when your first contribution was made to any Roth IRA. Let me just give you an example here that might help out. Let's just say in February of 2024, you want to make a contribution for 2023, which you can do. You can make up to tax time, you can still make contributions for the prior year. So February of 2024, you make a contribution for 2023. Well, now your 5-year clock has started, all based on the tax year that you put the contribution into the Roth IRA. So your 5-year clock now starts on January 1st of 2023. And the 5-year clock goes by as of January 1st, 2028. So as of that date, any of the earnings, as long as you've satisfied requirement number 1, any of the tax-free growth and earnings that you have in your account, you can now withdraw that tax-free because you've let the 5 years go by. Now, prior to that time frame, if you're to take out those earnings early, prior to the 5-year pass-by rule there, well, then you're going to be subject to income tax on those earnings. And if you're taking it out prior to 59.5, then you've got the 10% penalty. Now, let's go through a few common questions that we get is there a new 5-year clock for every contribution that you put in? And the answer is no. You see, or if you're to start, a Roth IRA here, and then you're starting another Roth IRA over here. And again, the answer is still no. You see, the IRS looks at all of your Roth IRAs as one, and the 5-year clock starts from your first contribution. So I'm just going to give you an example so that way, we're really clear on this. Let's just say you put your first contribution in 2005. And every year from 2005 until today, you're making Roth contributions. Well, your 5-year requirement is satisfied as of 2010. Even though you're still making contributions, it's from your first contribution into all of your Roth IRAs. So you're satisfied, in that example there, you'd be satisfied as of 2010. Now, Roth conversions are different. We're going to talk about that in requirement number 3. But before we get into that, I also want you to know that the IRS looks at Roth IRAs and Roth 401ks as two different things, let's call it. You see, they don't put them in the same pot. So if you had multiple Roth IRAs, well, guess what? The 5-year window, the 5-year clock starts when you put money into that first Roth IRA, even if you start multiple accounts in different locations. But your Roth IRA and your Roth 401k, those actually have two separate 5-year clocks. And so you need to be really aware of this. So let's just say, for example, you have a Roth 401k and you've satisfied the requirement. You've had that money, you've made your first contribution over 5 years ago in your Roth 401k. But you don't have a Roth IRA. Now you go to retire, you take that Roth 401k and put it into a Roth IRA. Well, guess what? The 5-year rule, the 5 years that you've satisfied, does not transfer over. So if you're going from your Roth 401k to your Roth IRA, now you're starting a new 5-year clock if you never had a Roth IRA before. Now, if you did and you'd already satisfied the requirement, guess what? Take that Roth 401k, put it in the Roth IRA. You'd already satisfied the requirement. All is good. The reason I bring this up is because at some point in time, you're probably going to want to make a withdrawal from your Roth 401k. And maybe you want to take control of your assets and do a rollover. Well, if so, you're going to want to do that rollover as soon as possible. So that way now, if you never had a Roth before, you're going to satisfy your 5-year clock. And then that way you're ready to take out those earnings, that tax-free growth, take that tax-free income later on in life. So it's good to know, again, the Roth 401k, Roth IRA, you're looking at two separate 5-year clocks on those that you need to satisfy. Hopefully that's brought some clarity to the 5-year clock and the 5-year requirement on your Roth IRA. So that way you meet that requirement. And again, this is regarding contributions. You meet that requirement. You meet the requirement that we've talked about in number 1, age 59.5. Now you're getting that full advantage on your contributions for your Roth. You're getting that tax-free growth and you're getting that tax-free income. But next, because I know a lot of people are also using Roth conversions to help lower their long-term taxable income, let's make sure you're also satisfying the requirements for Roth conversions so you can take those gains out tax-free as well. Requirement number 3 is that distributions must meet the Roth conversion 5-year rule. So if you've done a Roth conversion, pay attention to this rule because there's a big difference from Roth contributions. Now, 5 years must pass from when you've done the Roth conversion to be able to take out any portion of your conversion, the base portion or the earnings, tax-free. And here's the big difference from your Roth contributions. Each Roth conversion has its own 5-year period. So let me give you an example here that I think will really help bring some clarity to it. Let's go back to our previous example. You started making Roth contributions in 2005. Well, for Roth contributions, then all of your Roth contributions, the 5-year period was satisfied as of 2010. Now, let's say in 2022, you decided to do a $100,000 Roth conversion. Well, now we're doing Roth conversion versus Roth contribution. This Roth conversion has its own 5-year period, and it won't be satisfied until 2027. Let's say in 2023, you do another Roth conversion, this time $50,000. Well, guess what? The 2023 Roth conversion you did has its own 5-year period that won't be satisfied until 2028. So it's really important that you understand the difference between Roth contributions and the requirements that you must meet for Roth conversions. As I said, it's a combination. You need to either satisfy the requirements of number 1 and number 2, number 1 and number 3, or maybe you have contributions and conversions, so you need to satisfy 1, 2, and 3, all depending on your situation. But hopefully today brought some clarity to you, because the Roth is a really powerful tool with a lot of great tax advantages to it. And we want to help make sure that you get that money, that tax-free growth, and the tax-free income. We want you to get it all tax-free without paying any sort of penalties. Hey, I really hope that you found some value in today's video. And if you'd like to see additional videos on retirement, how to minimize the taxes on your IRAs and 401ks, or about Social Security, subscribe to our YouTube channel, as we're coming out with new videos each and every week on retirement topics just like those. Thanks, and have a great day.